Welcome to this Killick Explains video and welcome to number 4 in my series on dividend basics. 1, 2 and 3 you can find on YouTube or on the website if you like. This is number 4 and this is going to ask the question, shares or bonds? Now just a reminder, why are we talking about dividend basics? Well, I did a series before this one on income basics and shares were in there in the selection, so now I'm zooming in on dividends because a lot of people are looking at shares as a potential source of dividends. But here I want to answer a question which has become increasingly relevant when it comes to income generation, shares or bonds. A few years ago there was a hands down winner, shares, because bonds pay next to nothing, but that is not true anymore. So let's go into how you might start to make a decision between the two, or maybe you have both. So shares basically pay dividends, bit of jargon first of all. Bonds pay a coupon or interest. So both can provide an income. So how are we going to choose between the two? Well, some dividend basics, and go back to video 1 in this series if you want more. Dividends are determined by the directors of the company. So they're variable. In other words, they can go up as well as down, they can be cut, they can be reduced, okay, and that is something to bear in mind. Coupons, on the other hand, are set by a bond prospectus. So a bond will have an amount it has to pay in cash every year, or effectively the directors risk the bond being called in by bondholders, risk breaching the terms of the original agreement, if you like, between bondholders and the company. So they're usually fixed and they have to be paid. And that's the first thing to bear in mind. They are slightly different types of income. Now there is a thing called a preference share, I mentioned in video 1, which behaves a bit like a bond and carries a fixed dividend, but they're more unusual. Usually, when you're having the conversation about bonds versus shares, you are comparing the fixed income, which must be paid on a bond, to the variable one determined by the directors, which they'll be under a lot of pressure to meet, but they don't have to, and that's the point. So you tend to get dividend shocks. Sometimes you don't generally get bond shocks unless the issuer actually goes bust, in which case there's a whole new world of pain to consider. Okay? Now, returns. Here's some more jargon. Dividends generate a yield. Okay? That is the annual dividend divided by the current share price as a percentage, and I talk more about that and some of the safety checks in video 2, so I'm not going to witter on about that here. Bonds, if you're looking for income, pay an income yield. And that is the annual coupon as a proportion of the current price. It's not the total return, okay? We are stripping out here the yield in both cases, all right? And now some twists. So you're thinking, thank you, Tim, I've got that. Different types of income, slightly different calculations in terms of the yield, ways to look at the return I'm getting, if you like. What about the twists? Well, shares are known as permanent capital. I've hinted at this. In other words, companies issue shares and they don't generally plan to buy them back. Now, of course, some do. There is a thing called a share buyback, but they're known as permanent capital because the directors are under no obligation normally to do any sort of buyback. So therefore, the total return is a little bit unknown with shares. You have got a yield, you're going to have some capital appreciation, but you can't really predict that beyond a kind of guesstimate, either an educated one or a wild one. All right. They also rank below bonds. I've mentioned that. So in other words, if a company gets into financial difficulty, basically the dividend will be cut before a bond coupon. And if it gets into real difficulty, dividend shareholders, if you like, will be paid after bondholders. That's what I mean by ranks below bonds. But share ownership does come with a few handy perks. Now, not everyone appreciates these perks or uses them, but unlike bonds, you get voting rights. So you can turn up at the annual general meeting, a warm room, some current buns if you like, and actually vote on matters that affect the future of the company. Now I'll be honest, as a retail investor you'll be outvoted by the institutions sitting at the front, all right, with their big block votes, but nonetheless you do have the right to at least speak and be heard, and some people do actually exercise that right, and I think correctly so. Okay? And there are additional perks. Shareholders do get discounts on products and so on. There are some things that come with shares that don't always come or rarely come with bonds. Okay? Now, it's worth bearing in mind that yields are an indicator of relative risk in both cases. All right? So broadly speaking, the higher the yield on offer from both shares and bonds, the higher the relative risk of piling in. And I've spoken about the risk on dividends in video 2. And in both cases, therefore, diversification is crucial. Do not in the equity market go chasing individual stocks with juicy yields. That's incredibly dangerous. You can't actually do that in a bond market for the simple reason that retail investors can't buy individual bonds. So the sensible way to look at both, I'll be honest, is through a diversified portfolio or fund. Now, a portfolio put together for you, for example, has some benefits in terms of transparency, your vote in terms of what's under the bonnet, if you like. Some people like funds, but you are handing your money over to a fund manager, all right, and largely leaving it to them to decide how that portfolio looks. But you do need diversification. Do not go chasing single stocks. And even if you could, you wouldn't want to go chasing single bonds either. Now, hopefully that gives you a little bit of a flavour on how you weigh these two things up. And the reality is that they both play an important part in both an income portfolio and or potentially a capital growth portfolio. You know, in other words, bonds and shares both have advantages and disadvantages, and it's worth having a conversation potentially about how you can maximise what you get out of both components. To find out more about what is a pretty big topic, killick.com/learn has both a bonds and a shares tab if you want to dive into those. Then you've got my guides. These are the how-to guides, the colourful things next to me. That's editor@killick.com. There's one in particular with a grey cover that looks at some of the ways of generating income, and shares are one of them. It's so popular that there's not an example next to me. That's how fast those go. And if you want to read all about investing in shares, investing in bonds in a sort of practical context, well, this blue thing next to me here, Confidence, the quarterly magazine, I edit that, and that often has a section dealing with shares and bonds. So that would also be editor@killick.com. And as a reminder, final reminder, this is the last video in a series of 4. So if you look back, you'll get the other 3.